I've seen a lot of opinions expressed lately in the last 48 hours or so about the Silicon Valley Bank collapse. And so I wanted to create a short deck to hopefully explain to people why this situation is unique, different than the situations we faced back in 2008, and how it might affect other banks as well if the government doesn't step in and kind of deal effectively with the need for depositors to get their money back. First, what is Silicon Valley Bank? It's the 16th largest bank in the US. And for people that don't work in the tech industry, may not have heard of the bank, but it's really an important player in that ecosystem because their clientele are the venture-funded companies that are kind of the backbone of the innovation ecosystem in the US economy. So the clients are small, medium, and larger venture-funded companies, and they're investors. And amazingly, this is amazing statistics. They serve about half of the U.S. venture-backed technology and life science companies. So an important piece of the American economy. So as a result of that, their cash inflows and outflows are really driven by the venture-backed investment activity in the U.S. And the last few years have been great, and in particular, 2021, a lot of money went into venture-backed startups, and those companies took that money and deposited it with the bank. And usually what a bank does, it takes deposits, lends the money out, that's how they make money, and keeps a bunch of money for reserve should the depositors want their money back. And there was so much money that came in, so they had to allocate it into different assets, but one of the categories that they had to allocate it in is the assets available for sale, and we'll see how that comes into play. Because in the last 12 months, as opposed to what happened in 2021, in the last 12 months, you had the cash outflow because following the public market correction of 2022, VCs stopped, pulled back on their investment activity. And as a result, companies now need to pull that money that they had banked with SVB to be able to fund their operations. So one of the things that the bank did in the assets available for sale, that is short-term assets that they can quickly sell to be able to give money to depositors, they may invest in short-term secure assets. And that would be like a US Treasury bond. So if you bought that bond in 2021, let's say a 3-year bond, you would expect to get 1.79% interest rate for 3 years. And so that would be the par value. If you invested $100,000, the par value would be $100,000. Now, that same bond, if you bought in 2023, you would make a lot more because the Fed increased the rates. And so an investor would expect to get 4.71%. And so the par value for $100,000 at the 4.71% rate is $100,000. However, if you were looking to sell the bond that you bought in 2021, well, that is worth less now because a new investor would not want to pay par value because the inflows of cash are a lot less. And so if you do the math, it's basically an 8% discount that you would have to pay at the new interest rate. And that's really what happened. Going back to the picture again, where you see a lot of cash outflows because companies are now pulling money out of their accounts. The bank needs to satisfy the need for clients to get their deposits out. And so what they did is they sold their AFS portfolio, a good chunk of their AFS portfolio, which is available for sale, short-term assets. They sold $21 billion and they realized the loss. And the loss, again, is driven by the increase in rates that now makes those securities that they held less valuable. And you might argue here that like they should have hedged that risk, and you're probably right. But whatever it is, what the bank did, they announced to the world that we sold that, we had the loss, we're raising some money to secure our assets and reconstructing the FS portfolio, hedging against those floating interest rates, which they probably should have done it before. But there's nothing wrong with the bank at this point. The bank is just taking action to secure their assets. And if you actually look at their assets overall, they have a very low loan to deposit ratio, much lower than a lot of other comparable banks. And a lot of their assets are held in cash and fixed income securities that are very secure. And even if you look at the loan portfolio, that's mostly held in very strong performing credit performing assets, with the exception of maybe a few areas that may be affected by sensitivity to of performance by small companies, but even those are secured by equity holders in the banks. So there was nothing wrong with the company. So a lot of people are saying, well, this is bailing out the rich. Like, thinking back again to who is the customer for these banks. These are small, mostly small companies, small venture-funded startups that are trying to figure out how they're going to make payroll this week if the bank cannot figure out a way to get them their money back. And I put here a few of the tweets that I've seen on Twitter talking about challenges that small companies are facing, and you can go and see a lot more online. If you further look at the other comment I heard is like, this is like the rich people, the rich venture funds, and that's who are being asked to bail out. And that, venture funds basically is a pool of capital. It's a conduit for investments into these small companies. The money comes from so-called limited partners, or basically investors into these venture funds that might be a public pension fund or a corporate pension fund or a foundation or endowment. So the reach of this tech ecosystem goes beyond what you might think of as the rich guys in Silicon Valley. And so it's important to keep that in mind. So when you look at the risk of contagion here, the Silicon Valley Bank, this is the prior chart, 43% loan to deposit ratio. So if you're a company and you think the government no longer cares about depositors getting their money back, and again, like I want to emphasize again, Silicon Valley Bank didn't do anything wrong, didn't invest in unsafe assets, nobody took unnecessary risk. None of these companies went and did anything other than bank the money that they got from investors into a bank that historically has been the mainstay of the banking sector in the tech ecosystem, right? Nobody did anything risky. But if you now think that this is contained, think about it from the perspective of a small company that now has money into one of these other comparable banks. And I don't know anything about the financial situation of any of these banks, but that's the point. Like, why would you take risk that something similar wouldn't happen to any of these other banks? So basically, you would have two classes of banks, some big banks that are too big to fail, and so your deposits are safe, and some smaller banks where, people basically don't care and you may lose your deposits. Where would you keep your money? And so that's the important point here, is that there's a very high risk that if the government doesn't step in and do something, you're going to see the same effects in many, many other banks come Monday.